Hey guys, what's happening? It's good to be with you guys tonight. I had a little bit of technical difficulties. I thought it was actually my computer and thought that some things were going wrong. And in reality, sometimes, you just kind of just have a brain freeze or brain fart or whatever you want to call it. And I had selected the wrong camera. So if I select it's actually the right camera, but there's two ways for me to access it. So if I access it with a certain way, it makes me look like I'm just like shaking. So anyway, I've finally figured that out. So glad to be with you guys tonight, man. What a great week it's been. So I did a little research over the weekend, and part of that research was looking at a little bit about what we talked about last week about timing the market and that Microsoft, that Morningstar chart that showed, what happens if you miss certain days of the market over a long period of time and how poorly your portfolio will perform if you miss just those few little days. So I did a lot of research on that, and I wanted to share that with you. I'm hoping that it is not too detailed, but there are some cool takeaways from that. Then the other thing I want to talk about, I did exit my ADM, Archer Daniels Midland trade, if you want to call it that, my gamble, as we talked about last week. And what else do I want to talk about? Then I want to talk about just whatever you guys want to talk about. I'll probably save the ADM thing to closer to the end because I want to make sure I have time to get to what you guys want to talk about. So there we go. Let's take a quick minute here to see who all's on. I like to do that just because part of the value of this thing for me is just interacting with you guys. This is not something that I'm not the kind of person just likes to hear myself talk. I like to interact with you guys. So let's see. We got Michael Swami. Hey, Michael, it's good to see you. And Pat on his last live feed from the Gulf. He's heading home this week. Buddy, I hope you have a safe flight and that you get back and with safety and you can get some rest when you get home. So let's see. Greg's in the house. Welcome, Greg. Good to see you, buddy. And let's see. I'm going to kind of move down here. Kevin Mendoza. So we got K Squared in the house. Kevin Squared. Got Jacob here. Good to see you, buddy. It's a good idea to buy stocks knowing they're not good. No, is it a good idea to buy stocks knowing they're not good? I think you have to define what not good is because sometimes there's a diamond in the rough, right? And maybe we can talk about that here in a little while. Let's see. Kevin. Fast Eddie is in the house. Good to see you, my friend. And Tutomi. Oh, let's get to OJ first. Welcome, OJ. Welcome to the program. We got Tutomi here's with us, and then we got John Jay. So it's good to have you guys in the program tonight. So with that, let's go ahead and get started. And because I was having technical difficulties, I'm going to have to do a little screen sharing here. So just bear with me just 1 second. There we go. So the question at hand, can we learn from past market crashes? Now, I had this quote in my head, and I looked it up to see who actually said it. It's those who fail to learn from history are doomed to repeat it. And Winston Churchill said that, but the more I looked, the more I realized that there are a ton of people who have said this, and a ton of people get credit for saying it. So for right now, it's going to be Winston Churchill. So here we go. First thing is, this is what I showed last week, and it was a chart from Morningstar. You can see that. It says that if you invested all 5,035 trading days between 2000 and 2019, that your return would have been 6.1% on an annual basis. So, overall, every year you would have gotten 6.1%. If you missed the 10 best days, then you would have only gotten 2.4%. If you missed the top 20 days, and remember that's 20 days out of 5,035, then you would have 0.1%, pretty much break even. And this keeps going until you hit 50 best days. 50 is what would that be? 1% of the trading days over a 20-year period. That's not very many. So then you would have actually lost 5.5%. So now, obviously, those are selected days. So it's not like you can, magically pick those days. But I think there is an important concept here, and diving into this data will make us better investors, I think, by looking at it. So with that, here we go. I'm going to take poor old John Jay off the screen here. It looks like he's screaming at me. Hello. All right, there we go. All right, so I did a little research, and I actually grabbed all the data. I know I'm a nerd. You don't have to tell me, but I just have, at least if I'm not a nerd, I have nerd tendencies. Okay, so I got the data of the S&P 500 all the way back to 1927, and I looked for the best performing days and the worst performing days. And there was a lot of data there. I mean, if you think about it, that's almost 100 years. So, and then you had the Great Depression and all that. And so what I decided to do was to limit the data back to January of 1987. So that's basically, what would that be? 30 something years, right? So that's a pretty long time. Plus it kind of is more recent, and it's things that we may have even experienced ourselves. So you can see here that 13 worst. Why did I put worst first? Huh. I don't know. Oh, actually, it's the best. So sorry about that. There's a typo here. Let me fix that for you. There we go. That's the best. So these are the 13 best days of 9,375 trading days. So this is not 1 point, it is 0.14% of the days. You can see that the worst performing or the best performing day was 11.58%. And guys, I calculated this in Excel, so I may have missed something a little bit, but it's going to be directionally correct. But October 13th of 2008, it was an almost 11.6% gain in 1 day in the market. That's a pretty big move. So you can see that there are 13 of these. You can also see that I have color coded them. And we're going to talk about that here in just a minute. I think there's some fun things to learn here. The second slide here is the 13 worst days in the market. So we have 13 out of 9,375. So that is also 0.14%. And you can see here, I've color coded these as well. And I'll show you what that color coding is. But the worst day, percentage wise, the worst day since January 1987 was a loss of 20.47% in 1 day. I remember that day. That was October the 19th, 1987. And it was a big day in the U.S. So that, and then of course the next one is 11.98%. I mean, those are crazy numbers, right? Those are only in 1 day. So we got 13 of the best days, 13 of the worst days. Let's see if we can kind of put this together and make some sense out of it. So first of all, the purple, so you saw some purple here. The purple, there were 3 days, 3 of the top 26 best and worst. There was 13 best, 13 worst, so there's 26 total. So 3 of the top 26 were related to Black Monday. Black Monday was October 19th, 1987. There was, on October 19th, the stock market crashed by 20, or the S&P 500 crashed by 20.47%. But here's what's interesting is that on the 21st, it rose by 9.1%. And then on the 26th, it dropped again by 8.28%. The point here, one of the points, is that in October of 87, this was not that nobody got an inflation number or anything like that. There was simply fear and panic in the market. They were concerned that the government was not going to be able to balance its budget, and there was just a lot of uncertainty there, but there was no significant economic news. So it's not like somebody came out and said the world's coming to an end. It was just fear and panic in the market. So that's number one. Now, number two. Oh, I'm sorry. I'm not finished with this yet. So you can see here that on Black Monday, look how this just basically crashed. I mean, that is crazy. Let me do this, make this a little bit bigger. Hopefully that'll help. But you can see here how that just basically crashed. And then it came back, and then it went back down again. It came back. So there's a lot of volatility here. The other point I want to make here, though, is that it took just under 2 years. Yeah, Dresh says buy that dip. Absolutely, my friend. So it took about 2 years, just under 2 years, for the S&P 500 to get back to the level that it was prior to October 19th of 1987. So it took a little while. The second date is the Great Financial Crisis. Now, I remember the Black Monday in 1987. There's probably not a lot of you watching here that remember that, but I bet there's more of you that remember the Great Financial Crisis. You might have been in high school, but you might remember that. So here's in September of 2008, the S&P went down 8.8%. On October 9th, which was about 10 days later, it went down 7.62%. Then on October 13th, just 4 days later, it skyrocketed back up by 11.5%. Then on the 15th, 2 days later, it dropped by 9%. Then it went up by 10.8, and then it went up by 6.9, and then it went down by 6.7. So the just remember here, though, that I didn't pull all the dates. These are the top 13 percentage movements in the market, of all time. So it's not, there's probably some other smaller gains and losses here, but these 10 of these dates come from the Great Financial Crisis. So you can see here that the Great Financial Crisis, there was a sharp decline, and then it just kept going. And looking at this chart, you think, oh, that wasn't long, and you're seeing the future, so you're like, hey, stay the course. But man, when the market is crashing like this and you're in the middle of it, it's a little different deal emotionally than actually looking at it in the rearview mirror. So this took about 3 years for the S&P 500 to come back to where it was prior to the Great Financial Crisis. The last one that we'll point out, and this is 8 days. So out of the 26 best and worst days, 3 of them were Black Monday, 10 of them were the Great Financial Crisis, 8 of them were the COVID panic. So that's 21. So 21 of the 26 worst days were in 3 distinct events. So I think that's important as well. So you can see here, S&P went down 7.6 and then down 9.5. Then on March 16th, a few days later, it went down 11.98, almost 12%. Then March 17th, 1 day later, it comes back 6%. Then a week later, it comes back 9%. And then 2 days later, it comes back 6%. So the point of all of this, well, before we get to the point, here's the COVID pandemic. And I will be honest with you, I did not expect this. I thought the COVID pandemic would cause something more like the Great Financial Crisis, right? Where you've got, several years waiting for the market to come back. But if you take a look at this, it took about 7 months for the market to come back. And the rest is history. You know that the markets went on to greater and greater heights from there. So what can we learn? One is that the 3 largest stock market crashes began with an unexpected large decline in a single day. None of these events started with a huge increase. They all started with a huge decrease. And what happens then emotionally is that everybody goes, oh my gosh, I got to get out of the market because it just crashed. And they pull their money out and they're trying to catch it on the way down. And what they don't seem to realize many times, and let me go back to this, is that it's just a few days later, there's a huge upswing, right? And let's look at the great financial crisis. Just a few days later, it's this huge, almost 12% increase. So many people will move their money out of the market and try to time it, right? They're trying to say, I got to get my money out before I lose it all. And in reality, they're hurting themselves because they took the loss and didn't capture some of the upside. So that's point number one. Point number two, there is no predictive pattern of market recovery after a crash. You saw that the Black Monday took about 2 years, took at least 3 years for the great financial crisis, and then the COVID was like 7 months. So there's no predictive pattern. The only predictive pattern is that it eventually recovered. I think that's what we have to remember as investors. Oh, I already said this. Black Monday, just under 2 years. Great financial crisis, 3 years. Pandemic, 7 months. Timing the market is easy looking backwards. It's impossible looking forward. And what I mean by that is a lot of times when we look back at this data, we already know how the story ends. And so we go, what's the big deal? Just stay invested. But when you're in the middle of the storm, it's a little different. It's a little tougher emotionally to stay in the storm, especially now for folks like us. We are savvy investors, and as savvy investors, we're going to stay invested in the market. But most of our colleagues, most of our friends, they don't think about the stock market. They got their 401k plan, they get their statement, they open it up, and they go, oh my gosh, what happened, right? So part of our role is to help our friends and colleagues understand the how to handle the markets. Let's see. Market crashes start by falling hard, and then getting out only locks in those losses. So just keep that in mind. Large market moves create emotions of either fear or exuberance because, if the markets crash, it's like, oh my gosh, what's going on? And if they're going up, like now, so when they continue to go up, then it creates this frenzy because people have a fear of missing out. So maybe it's fear of, just basically fear on the downside and then fear of missing out on the upside. I'm not really sure. I hadn't thought about that. So winning, though, requires swimming upstream against our emotions. When the markets are crashing, we want to get out and we got to swim against that tide. When the markets are going way up and we're missing out on all these gains, if we're not investing right away, like NVIDIA, then, sometimes it's necessary to kind of put that fear of missing out on the back burner and go against the emotions. But it's really hard to know when to do that, right? It takes emotional strength not to follow the herd. And that's a lot of times on a short-term basis, that's what goes on in the market. It's a herd mentality. And that's why these technical analysis kind of works, right? It's because there is a herd mentality and they've seen it a lot and they can actually predict very short-term using technical analysis. Practical application, those who invest in the overall market indexes. So what do you do if you're just a market index investor? I would just say, what do I know? But I would say set it and forget it. If that's what you want to do and you want to put your money in the S&P 500, you don't want to think about it anymore, then just set it, forget it. Don't even listen to the news, right? Just keep your money in there. And, when you're 60, 65 years old, take a look and see how much is in there. Because history indicates that the overall markets will rise in the long run. So what about those who invest in individual stocks or sector-specific ETFs? So I found this quote online. I thought it was really good. I'd never heard of this guy before. His name is Jeremy Grantham. Some of you guys may know who he is. He runs some some big investing firm up in like Boston area, up in the northeast. He says market timing, by the way, is a tag some buy and hold investors use to put down anything that involves using your brain. These are the same people who like to watch the locomotive coming and get run down in the name of discipline. So, I think that's a good point. He probably could have said it a little better, but who am I to correct him? He's a very wealthy man. But I think he's right. I think there is an intellectual part to investing. It is not about just buying and holding. It is about investing. There are techniques, there are principles of investing that are important for us to learn over time. We never know them when we first start, but we learn them over time. So blindly throwing money into the stock market is not investing. So if somebody's out there just throwing the money in the stock market, they are not investing, they are saving. And it just so happens they are saving in an investment vehicle. So to those who invest, again, some more points, learn macroeconomic terms and their market impact. Know about inflation, know about the Fed, know about money supply, know about the things from a macroeconomic perspective. I know my buddy Ari likes to say macro matters, and I think he has a point there. It is something that we need to understand as investors, and sometimes it actually shapes the decisions that we make. And I've actually put some of these in here. I did this the other day, so I'm surprising myself with some of these. So the question is, do higher rates impact Microsoft? Probably less so. What about NextEra Energy? Probably more so than Microsoft because they're more capital intensive. What about Realty Income? Right? So those are questions that we need to ask ourselves. Then the second point is learn to read financial statements if you haven't already. Those are really important to understand the health of a company. Develop a consistent investing process and model and follow it. And as you find out maybe ways that you can make that better, make it better. But follow your process and model. Learn how to value a business. Sometimes people will say, you can't time the market, so I'm just going to buy the stock. It doesn't matter what it costs. I would say that you probably need to have some way to value what that business is, and if you want to buy it at that price, it doesn't matter to me. But at least know what the value is. Know what you're getting yourself into, and you know what, you get to make the decision. You are the chief investment officer of your portfolio. There's nobody else who is telling you what to do. So, but I would just recommend that you learn how to value business if you don't already know, and invest based on solid fundamentals, not market timing. So those are my thoughts for today. And, there will be a quiz at the end. I will email that out to everyone, and you cannot leave the program until you have finished the quiz. No, I'm just joking. There's no quiz. All right. So there we go. Let's find out kind of who's joined us since I started. And then let's kick it around a bit from you guys. What do you think about this? Oh, let me ask you this question. And I'll share this with you. I bought a stock today that is new to my portfolio. I want to see if you guys can guess what that is. I don't know. I don't know if I could guess what it is if I hadn't done it myself. So, all right. So let's see. I need to come back up here. OJ, John J. Yeah, so Fast Eddie asked the question, are all crashes the same? Is a better question. And I think what we found out is that no, they're not all the same. But one thing they all have in common is that they started with a crash. So once you see that, then you know it's on. Game on. So, all right, Jacob, let's see. I bought some Heritage Insurance stocks because I wasn't expecting them to move much. In my opinion, a stock that doesn't go up is bad. Huh. Okay. Well, That's an interesting perspective, Jacob. I've got some stock that haven't gone up as well, but I wouldn't necessarily consider them bad. And here's why I say that: the stock market is, as Benjamin Graham would have said. Actually, he did say this, that, and he kind of started it, and I think Warren Buffett actually molded it into what it is today, and that is that the market in the short run is a voting machine, but in the long run, it's a weighing machine. Now, what does he mean by that? He means that in the short run, the market is driven by a herd mentality. So right now, all of this stuff going on with Nvidia, there's this hype, and everybody's, when you see it in the Fantastic Seven, right, or whatever they call that, except now it's like the Fantastic Five because two of them aren't doing as well. But you see folks like running into those stocks because they're making money, and they're making money. They are going up in value, and in reality, it's there's some other companies out there that are very good that aren't moving because all of this money is going into these few stocks. So I don't know. I like to value companies and businesses, more than I like to try to predict the price of a stock. And I think in the long run we win that way, but sometimes it doesn't work out so well in the short run. So I don't know, my friend. That's the only comment I got on that. John Jay says, "What if you lost the top 20 worst days, parked it in 5% treasuries, and jumped in and cleaned up at stock's low point?" So that would be timing the market. And if you could do that, I would give you my portfolio to invest for me, because the only way to know that is like to just be clairvoyant. You would almost be a deity if you could figure that out. So it's a lot easier to do looking backwards, but I don't know when the next crash is coming, and when the next crash comes, I don't know how long it's going to be before you get a jump like that. So we saw that sometimes it was just days later that the market was just very volatile. So I don't know. I mean, that mathematically that would work, but I don't think you could actually pull it off in real life. But if you can, my friend, you are gonna make some big money. Also, can you compare 1970s to now? Very similar. What do you think? I could do that. I have the data, but I will tell you that the biggest volatility that I saw in the overall data was in the Great Depression and in the Great Financial Crisis. So those were the biggest, or maybe the biggest, the longest streams of volatility were in those two time periods so far. So I just finished reading a book called The Psychology of Money, which is fascinating. I'm going to do a video on that for those who are in my inspiration tier. So it's fascinating. It's a fascinating book. If you have not read that, I would highly recommend it. Yeah, so Kevin Mendoza says he's excited for Jerome Powell's big speech. So what do you guys think is going to come of that? I mean, do you think now I would venture to guess that all of us believe that he is not reducing rates this week. And I would be totally shocked if that were the case. But I'm not really sure what he's going to say about the future. And I'll tell you, I mean, there is some talk about them not reducing rates this year. Maybe that's a little bit of, what do you call that one? Hype. Maybe it's a little bit of hype. But at the end of the day, we can't rule out it. Just as investors, let's just speak honestly and open with each other. We cannot rule out the possibility of a recession. A recession could happen. And these Fed rate movements are not an instant impact. They are made, and then there's a lag into the future before they actually take hold, right? And so, knowing when to make those moves is a really big deal. And I don't know if they got a handle on it, to be honest with you. Kenji says those are crazy numbers. You are right, my friend. Oh, look who has joined us. It is X to the what, X to the who, X Dividend Dad. Welcome to the program. And yeah, we already talked about this. Buy that dip. That was great, man. I really love that one. Let's see. Let's see what we got here. John Jay says, hey, Kev Dog, I remember 1970 stagflation and inflation. Then in 1981, interest rates were 18%. I remember that too, but I was actually kind of young then. And yeah, I would anticipate that you were as well. But yeah, those were bad days. I remember, having to wait in line to get gasoline. It was a bad time. But, we didn't know it because I was young. I'd never seen anything different. That was just the way life was, Let's see here. Yeah, Dresh, got to catch that dead cat bounce. Yeah, that's right. That's what some of those were, right? Were dead cat bounces. But if you get out before the dead cat bounces, then you're not helping yourself, right? So let's see. Yeah, Pat says as long as the dividends still come in, he will always hang in there. That's right. I think that's one of the things about dividend investing that is good is that we do have that dividend that's coming in. Dividends are never guaranteed, so we don't know that they will be there. But if we invest in solid companies who have solid cash flows, then chances are we're going to have some good dividends coming in. They may not grow as much as they had in the past, but at least they will be there. So let's see. Okay, Kevin Burgess, what would you buy if the market tanked tomorrow? So let me see if anybody's guessed what I bought today. And I don't see any guesses. Oh, I do see one, but that's no. All right, let me hit these. So, Dresh, I'm going to come back to your question, but I think this is what I would buy if the market crashed. So I don't want to give that away just yet. So let's take a look at Dresh wants a hint. So let me look and see how we done. So FMC, eBay, no, neither of those. Hershey, no, and this is a stock I do not have in my portfolio, so that is a hint. But it does open up to probably 12,000 stocks that are out in the stock market. This is another utility, so that kind of narrows it down. There's not a lot of those out there, so if you guys want to try to guess that, enjoy. Oh yeah, so Kevin Mendoza has enjoyed reading the interpretation of financial statements by Warren Buffett. Ex Dividend Dad says Next Star Media. No, that's not it. That's not a utility, but you didn't know that when you put that in. So Ex Dividend Dad says I bought Apple, and I did not buy Apple. And oh wow, you nailed it, my friend. It is not Duke. It is Next Era Energy. Greg got it as well, and John got it. And so yeah, those are good. Those are good guesses. So I'll chat about that here in a second. But let me go back to Duresh here. I think Duresh was, yeah. What would you buy if the stock market tanked tomorrow? I think it would depend on what tanked more. I would say if Microsoft tanked really bad, I would probably be looking to pick up more of that. But, right now I'm looking for some stocks that are a little bit more predictable and solid, and utilities kind of fit that. Plus, I will say this, that utilities are, highly capital intensive. And because interest rates are higher, they tend to be negatively impacted in stock price when the interest rates are higher. And so if we, at least at some point, whether it's this year or next year, whenever, those interest rates to actually come back down, then I'm expecting some push upward in prices for the utility industry in general. And so as you know, I have a bunch of shares of Pinnacle West Financial out of Arizona, and I have some shares of WEC, Wisconsin Energy, We Energies, I guess they call it. And then now I own a few shares of NextEra Energy. There's some things I do like about NextEra Energy. Let me share this with you really quick. Well, why has it got to be quick? We're here for the evening, right? All right, let me go to this right here. So I'll take Dresch off there. Oh, that's not it. I must have shared the wrong thing here. So we are going to share the screen of this. Okay, this is NextEra Energy. Now, I put a slide like this together every quarter. I put this together for my holdings. And then when I'm looking to, when I'm actually researching a stock, I will put something like this together. I will lay out, I'll listen to their earnings calls. I'll look at their investor materials, and I will pull out some things that I think are meaningful. And that is, customer growth in Florida. You got the GDP in Florida going up. These are, so if I look at NextEra Energy's income statements and balance sheets, I can see that it's made up of FP&L, which is the old Florida Power and Light, as well as Energy Resources. Now, Energy Resources is, things like renewable energy. So it'd be, solar and wind and all of those types of things. So, and you can see here the breakdown between the traditional utility and Energy Resources, but there's just a lot of info around that, and then some takeaways, and then what do I plan to do. And I actually share this in my Discord for my inspiration tier. So if you're interested in that, you can look in the comments to the to this thing. But this is kind of where what led me to NextEra Energy. So just thought that would be kind of fun to see. Maybe not for you guys, but anyway, it was fun for me. So that's what matters, right? All right, let's see. So Dresch, to kind of put a bow on that question, I think that the market could tank tomorrow. I don't know. It could tank 10 years from now as well, but I'm looking right now for some things like NextEra Energy, like Pinnacle West, that are going to be solid investments for me, and at least in the near term, in an unstable economic environment. So I don't know how else to say it other than that. Let's see. Kevin Mendoza wants to know, is it true people are selling their stocks and buying crypto coins instead? I don't trust crypto. And, to be honest, I don't know. I've not seen anything or read anything on it, but I will tell you that I am not doing that. I don't trust crypto either. I think crypto is a win-lose. I think it is gambling. I don't think that they're, like in the stock market, as companies do well, the pie gets bigger. And as the stock price goes up, the pie, the company itself is getting bigger and is able to sustain that, and we can all win, right? But I think crypto is a little bit more win-lose. And so I just don't enjoy win-lose. So let's see. Yeah, Michael points out here another point to that data, and that the large up days are always in close proximity to the large down days. And so I think that's important, because I think people oversell, right? The market is going down. This is an emotional reaction. Maybe it's computer trading too. I don't know. But everybody's like selling to try to get out, to try to limit their losses. Then all of a sudden they realize that, shoot, I should have stayed in there. And then they start buying back. And so it comes back just a few days later. But, then it could go down 2 days after that. So it's just very volatile. And the only time you get hurt, I can't say that. many times the only way you get hurt on a roller coaster is if you jump off. So when the market gets volatile like that, I would recommend, and I recommend for myself that I don't jump off, that I just ride that roller coaster and, see what happens. So John Jay's been at it a lot longer than all of us, he says. Yeah, I can't wait to hear how old you are, my friend, if you're willing to share that. Because I'm probably close to you. Let's see. Yeah, I agree with you, Michael. He's criticizing buy and hold. I don't. That's why I said I think he could have said it better, because I don't think there's anything wrong with the buy and hold strategy. Because if that strategy is your model and that model works for you, then buy and hold, right? Um, but don't buy at any price, right? And don't hold when your investment thesis breaks down, right? So when Intel cut its dividend, did you hold, or did you decide, hey, I don't trust these folks anymore? So I think that's the spirit. At least that's the spirit that I'm coming at it from. I don't know him at all, so I can't speak for him. Yeah, John Jay says he's worth $1 billion. So hey, that's pretty good. Kenji loves these lessons. Hey, I appreciate it, my friend. I enjoy doing it too. I think it's just kind of fun. I I did I don't know if I'm a nerd, but I did play one on television. Sorry, a little punchy. I'm drinking this water tonight. Okay, let's see. I think I've gotten through some of these, because this is when you guys were guessing. Okay. Yes. All right. Oh, yeah. Michael's from Texas. Oh, I didn't know that. Gexa is out of Texas and is a sub of NextEra Energy. I was not aware of that. That's good to know. I know there's a lot of players in that Texas. What is it? The ECOT market down there. I think that's what they call it. Okay, Slammer 6789. Welcome, my friend. I haven't seen you yet in here today. Thanks for the info. Looking forward to hearing your psychology of money thoughts. That is going to be fun. I've already written the notes, and now I just need to kind of encapsulate it and put it in a video. So I'm getting very close on that. Do I like NextEra Partners? It's NextEra Energy's subsidiary. I don't really like that. I think they have too much debt, and I really like NEE better for the purpose that I have it in my portfolio. If I had a need for something along the lines of Napa, I would be okay with it. But I'm just not. I'm not real wild about NEP. Oh, why did I sell ADM? So it is 750. So let's go ahead. Maybe that's a great point to Tommy. And let me just share with you what I did. I'm going to pull that up here, and I'm going to share that with you guys. This will be all of the transactions that I did with Archer Daniels Midland. And it is right here. Share that. Okay, so let me do this. Yeah, I need to, actually, I can make this bigger. Hold on. I need to make it where we can see it a little better. Does that help? I think that helps a lot. Okay, so this is an analysis of ADM transactions by Kevin Burgess on a FIFO basis. And basically, I put down every purchase that I made and every sell that I made by date. And sometimes I split these up because I didn't sell in exactly the same shares that I bought in, but I left the integrity of the price there. So for instance, these two here on January 22nd, I bought 150 shares here for that 55.4001. But when I sold it, I sold 100 shares, and then I sold 50 shares a day later. So, you get the point. I really wanted to break this down so that I could see by trade what it was. So you can see that I bought on January 22nd. I bought on the 26th, the 27th, 29th, the February 13th, 21st, and 23rd. I ended up with 1,000 shares of ADM, and my average purchase price was somewhere around $53.55, which made a total purchase price, drum roll, was $53,554, which is this times 1,000. And so here's all the sells, and then I sold at an average price of $59.09. My sell was $59,000, so the gain off of that was $5,537.75, or 10.3% gain. And then also what happened was during this process, they paid me a dividend. Isn't that awesome? I really appreciate them doing that. That was $325. So total return was $5,862.75, or a 10.9% return in less than 2 months. So the way I like to calculate this, and the way I would do it if I were doing options, is that I annualize it based on the weighted average number of days that, remember I said I'm a nerd, but anyway. So on an annualized basis, that's nearly 100% return annualized, right? But so over 2 months, less than 2 months, was 10.9%. So, I'm excited about that. So the question is, why did I get out of ADM? So let me go back to, I'll just go ahead and get rid of this. Let me go back to Tommy's question. What is the reason you sold ADM? The reason I sold it is that my investment thesis for ADM was this uncertainty that they were in. I did not need it for my portfolio. I don't like the cyclicality of it, so I didn't need it in my portfolio. But yet I could not pass up this opportunity because I felt that investors were overly selling this company. So I bought 1,000 shares, and then in less than 2 months, I unloaded 1,000 shares and ended up with almost $6,000 that I didn't have before. So that turned out to be a pretty good deal for me. Do I think it's a bad idea to hold ADM? No, I don't think so at all. I mean, if it's a company that you like and you're okay with the cyclicality, they provide a great service for the world in the food space. And so I think it's a great company to be in. I just don't particularly need it in my portfolio. And as you remember, I am trying to get down to 25 companies in my portfolio. I don't remember how many I have now, but it's somewhere around 26. So, I'm trying to get down to that 25 level. Getting rid of ADM was important for me to do that. So those are the reasons. It doesn't really have anything to do with ADM specifically and whether I think it's going to go down. It's not a bad company. It's not a bad stock. I just didn't need it for my portfolio. So hopefully that makes sense. Yeah, Michael said when Intel cut its dividend, he doubled down. Yeah, that's a great way to do it too, because and similar to ADM, I mean, the stock is worth at least something, right? And so when you get to the place like Intel, when I think it was down to 22 or something along those lines at one point, then even I was tempted to get in, and I don't even like Intel. I don't like their strategy, so I was even tempted to get in, but I didn't. And but you can't buy everything, right? Well, maybe this Jeremy Grantham can. So let's see. John Jay has been at it. Oh, Jeremy Grantham's been at it longer than the rest of us. His net worth is $1 billion. Yeah, there you go. And one of the things, John, that was pointed out in this book called The Psychology of Money is that Warren Buffett, and they use Warren Buffett a lot as examples, that Warren Buffett has invested in 400 to 500 companies in his lifetime. and he made most of his money on about 10 of those companies. So the point was is that sometimes you swing and you miss, right? Now, Warren always talks about, only hitting companies that are winners, but his real money came from just a few companies, Coca-Cola, See's Candy, those kind of things. Oh yeah, yeah. It's not Epcot. That's down at Disney. It's ERCOT. Yeah, great. Electric Reliability Council of Texas. Yeah, thanks for pointing that out. ERCOT. Yeah. Let's see. Thoughts on ARDC, Ares Dynamic Credit Allocation Fund. Simply Safe lookup. So let's do that for my friend. Let me remove. I'm gonna stop sharing that. Then we'll sneak over, if you guys want, to this, and I will sneak into Simply Safe Dividends. See, because my computer was down, I didn't even log in. So here we go. Oh, just like that, I'm logged in. Let's look up, and it was what? It was ARDC. I don't know that I've followed that. Ares Dynamic Credit Allocation Fund. It is a dividend yield of 9.91, dividend safety score of 50. Premium to net asset value is minus 4%. So that must be this must be a closed-end fund. Yeah, it is. It's a closed-end fund, and it's at $14.23. Yeah, they've got let's see, long-term buying opportunities may be most attractive when interest rates are expected to fall and remain low. So, it might not be a bad time for them. But I look at the dividend growth, John, and the latest was 4.4%, and that kind of makes sense, right? In an environment where interest rates are about to fall. But their dividend growth is basically nothing. And I don't know that they really are making more money either. So yeah, that's just not in my wheelhouse. I'm not a big fan of closed-end funds anyway, but hopefully that was helpful. My non-committal answer. Hopefully that was helpful. Hey, thanks, Kevin. I appreciate that, man. It worked out, and like I said, when I was talking about gambling, I typically only like to gamble when I got a good chance of winning. And I've got another gamble out there as well that I'll share with you if you want. And it has to do with something that we've already talked about. It has to do with Pinnacle West. Share screen. Let's go here. So this was the ADM transaction. And in this next tab is my Pinnacle West transaction. So let me make that a little bigger. And so Pinnacle West is a little different because I do own shares of Pinnacle West. So I put here that this is incremental, right? Incremental shares. So I'm planning on holding Pinnacle West. I'm going to own some Pinnacle West. I'm not going to invest in Pinnacle West. So, but these are incremental shares. There's an incremental 975 shares that I bought. Now, my original thesis, there was two parts to it. The first thesis was the rate case that they had gotten that was very positive. That didn't turn out as well as I thought and as well as I had hoped, because they ended up issuing, I don't remember how many shares, 9 million more shares or something like that, which diluted the earnings that they got from the rate case. So I ended up kind of break even on that. But I'm also aware of this macro environment that we're in. And as interest rates come down in the future, I think utilities are going to do well. there. But just to show you where I'm at here, let me make this a little bigger. Can you see that? So these are all the shares that I have purchased, and these are the incremental shares I purchased in Pinnacle West. Excuse me. Average purchase price is $69.78. You can see that here. And I have not sold anything yet. There's a sell price in here, but let me do this real quick. I only do that because I want to see what it would look like if I sold today. So, but I have not sold any of these shares yet. So let me go and find out what the price of Pinnacle West is today. So it closed at $72.08 today. So 3.7%. You can see how I'm doing this, right? I mean, all of these would be, if I were to sell out today, these incremental shares, I would end up with a gain of $2,240. I got an incremental dividend, $264. So my total return would be 3.7%. I'm not considering selling at this point. I'm waiting for the interest rates. I'm perfectly fine holding this company's shares for another year or so. So, I mean, at this level for another year or so. And, eventually I will want to bring it back down to a normal weight in the portfolio. Right now it's around 6 to 7% of the portfolio. But, I mean, this is what I do. This is kind of fun. I mean, this is like fun to me. I don't know if you guys feel that way, but I just enjoy that. Let's see. Oh, yeah. Tutomi says, nice profits on the ADM. Let me get this off the screen. And now it's time to pay some taxes. Yeah. And so the beautiful thing about this, Tutomi, is that the ADM transactions were all in tax deferred accounts. So one was in part of it was in a Roth, part of it was in a traditional. So at some point I will pay taxes on the traditional, but that's life. So fortunately in 2024 I don't have a tax event because it was tax deferred. This is a good question to Tommy. Any changes of your thinking about Whirlpool? And I think I'll make this the last question here. And actually I do have a couple of thoughts on Whirlpool. One is that they are really struggling, and this economy is hitting them a lot worse and a lot longer than any of us really anticipated, even the management team. So, I think I've got a couple of thoughts on that. One is that if it drops below 100, I'm going to buy some more shares. And number two is if it goes above 110, I'm probably going to sell some. So, I'm going to, if the stock price goes up a bit here in the near future, I'm probably going to I'm not going to get out of the stock. I'm just going to get it down to a normal weight in the portfolio. Go ahead and capture some of those losses and then move on. Right. I know Warren Buffett says never to never lose money on a stock, but sometimes you just got to look for other opportunities. So that's kind of where I'm at on Whirlpool at the moment. I'm not going to get out of it in total, but I do want it to not be as big a part on my my portfolio. So hopefully that helps. And let's see, is there anything else? Oh yeah, Kevin's got Pinnacle West as well. Good job, my friend. I think it's going to do well. I think NextEra is going to do well. I think Pinnacle West is going to do well. And I think Wisconsin Electric's going to do well. The only challenge that I have there is this whole natural gas pipeline stuff in Chicago. I think that's a big risk for the company. So, we'll see. So with that, my friends, I am going to get off of this stream and move on and go maybe see my wife for a little while. So I haven't seen her much today. So I think I'm going to go say hi. So, hey guys, I appreciate you joining. And as always, what we are trying to do here is just make each other better and help each other win, because this is a win-win environment. We can do this together. And so I'm glad you're here. I look forward to our next conversation, and I'll talk to you soon. Thanks.